Hello, everybody, and a very warm welcome to the Property and Investor Podcast. I am your host, Paul Lanfear, and before we get started, my inner lawyer needs to do the usual health warning. So, nothing in this podcast is legal, health, or financial advice. Naturally, do your own due diligence. And to just re-emphasize that, the subject matter of today is a highly regulated area, and just to be absolutely clear, neither myself or my guest are in any way giving advice during the podcast. It's a genuine pleasure to invite my to introduce my guest today, Rose Sharma. How are you, my friend?
Very, very good. And it's great to be here, Paul. And the last time we met in person, I think we did a course together about 6 years ago, but I never forget our Lebanese lunch together. And we just got on very well. So I'm really delighted to be joining you today. And it's a great opportunity for us to catch up.
I remember that lunch very well. I mentioned it to Liz not 24 hours ago. Um, so let's get straight into the thick of it. So full disclosure of the podcast today. The inspiration for this podcast was Ro recently chaired a panel discussion at Brendan's Central London Property Meet. It's a meeting that I've attended a number of times, spoken at, looking forward to speaking at again in the future. You're a big supporter of Brendan and his work. I think he organises a fantastic independent meeting, and I'm all about, the independent meetings, definitely. And you made this comment, Ro, which really piqued my interest, which was a relationship approach to raising private finance. And that's why we find ourselves today, and that's the subject matter of today. Um, I'm going to dip into your background in a moment, but I think we hopefully we both agree on this road. When there's nothing in this podcast that is even going to resemble financial advice. This is a difficult area to be in. It's a regulated area. You have an area, you have a background in financial services. I have a background in law, but neither of us in this podcast are giving advice. Do you agree with those sentiments?
Exactly. I'm just sharing some of my own personal experiences, which the audience can take what they wish from.
Perfect. So, and we're both coming from this from a practitioner point of view. So, you're an experienced developer in London, and from my perspective, I've been both on the kind of developer side, but also on the angel investor side. And albeit a decade ago, I was in had a decade in legal practice as well. So I kind of wear three hats in this conversation. And just to be clear, those three hats never agree with each other. But we'll see how far we go. So just background wise, you were a captain in the Royal Engineers and had a long career in the services. So just before we get into the subject matter stage, you want to tell us a little bit about that, yeah, and what that looked like and what you were involved with, and yeah, what were the high points for you in that?
Absolutely. So I was an army officer in the British Army, as you say, in the Royal Engineers. I served 8 years full time, having done some time before that between university, so between school and university, and a bit of sort of territorial army officers training corps at university as well. So I actually trained. I was actually commissioned into the Army Air Corps, so I trained as a pilot first and foremost after my officer training at Sandhurst.
Hmm.
Made it a year through pilot training, but unfortunately didn't make it all the way through to the end. Very, very tough course, but taught me a lot about myself and my skills and limitations and how I could learn from failure, which was really important. Having flown helicopters as well, it's not something I can envisage doing again unless I've done very well financially, but let's see. I served in the Royal Engineers. I served in Germany. I did operational tours in Iraq as well. As a Royal Engineer, you're responsible for construction, demolitions, bomb disposal. Well, that's a specialist area which I didn't get involved in. But it's very wide ranging. My skills in the military really gave me a lot of confidence in myself, especially on operational tours and some very hairy, high pressure situations. As you can imagine, in Iraq, 2006, 2007 was a very violent period. But as an officer in the army, you're taught to build relationships, build trust, consent, operating with integrity. You're a manager of people, manager of risks, a manager of projects, and you're kind of taught and given all the skills to lead by example and just make things happen. You're not expected to be the expert in any one area, but you need to know how to call upon those who are to get the job done. And obviously, As people will recognize who know me that I work with today, the military background has given me this kind of relentlessness to get the job done, because it's all about completing the mission, but obviously doing it, bringing the team along with you. So I left the military in 2008,
Mhm.
having kind of really enjoyed the experience and realizing the time was right for me to move into the next stage of my career. So I never intended to just sort of serve for life in the military. I thought 3, 4 years turned into 7 or 8 years. And I actually joined Barclays. So I was in a part of the global retail bank, got involved in a post MBA leadership program. I didn't do an MBA, but actually they really liked my military experience, which was seen as a credible alternative. And I worked in all sorts of areas, from heading a risk and governance a risk and governance function, working with third-party vendors offshore. I had teams in India. I worked in Spain for a year, worked in credit operations. I did some work in Moscow, in Russia for a while. I was managing a project in Italy. Spent a lot of time traveling, which was great, building some really good experience within a kind of complicated corporate structure. I then moved into the investment bank, actually, where I served for about another 3 or 4 years. So total, I spent close to 8 or nearly 8.5 years at Barclays. The majority of that time was in the investment bank, and that's actually where I really cut my teeth as a project and a program manager, where I was managing big, complex regulatory change programs. There was a lot of trouble for the banks during that period, 2012 to 16, where there'd been a lot of issues with e-communications, rate fixing, all sorts of regulatory issues which really needed to be clamped down on. So I was actually running a lot of those programs within the investment bank. A lot of politics, a lot of consent winning, building relationships, and just like swimming in treacle, just making complex change and projects happen. Very briefly, then I sort of left Barclays to sort of work for a small consulting firm, which was a lot more entrepreneurial, working again with more investment banks, delivering change. But I really kind of got involved in the business development. How do we build equity value into this proposition, this consulting firm, which was eventually acquired by a much bigger group? So I worked very closely with the founder to build that value into the firm. And that's when I realized that actually, you know what? I think the corporate world was never really the right place for me, because I was too much of a free spirit and an entrepreneur myself. So that really gave me exposure to sales and marketing strategy, the client proposition, getting deals over the line, as well as the delivery. And it was at that point that I decided, actually, I think time is right for me to go off my own and follow this deep-rooted passion in property. I've been building a property portfolio over the years as well. Just a very small, modest buy-to-let portfolio. And then I realized that actually I need to invest a bit more in education and getting involved in this space. And
Mhm.
my third career was property, and I've been doing that since 2017. And that's where I am today.
Very good. And in the process of doing all of that, you're also a podcaster as well. So you've got this podcast, and something really amused me in one of your earlier podcasts where you said something like you were starting to buy property before you left the army, I think, at that stage, and you managed to secure your worst ever performing investment without 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 giving you PTSD about that. Give us a sentence about this worst, because I think for a lot of
This
it, our first property investment is always the one that is just the worst, or at least everybody's got a problematic property. I remember Liz once in one of our kind of directors meetings saying to me, like, every year there is a different problem property, and it's always
mm,
true,
yeah.
so you kind of have to suck it up and get used to it. But give us a sentence on why that first one was such a shocker.
Yeah, I mean, well, firstly, I agree. You could do the same project twice in the same street, same house, and it might be a completely different set of problems for different circumstances. So back in 2006, I bought my very first property, which was an off-plan property. I think it actually just been completed and tenanted by the developer.
Hmm.
2006, the height of the market, as we know. Um, Incidentally, this is the cheapest property I've ever bought, but also still the worst performing. It was sold off plan with a tenant, or as I say, just built with a tenant who was paying too much. The value was too high, and this was during a period where you could pretty much mortgage, let's call it at 100% of what you were purchasing for, because the developer incentive or the deposit was kind of the discount that you were getting on the purchase price. Anyway, bought this place, and obviously within a couple of years, the market value tanked, the rental value dropped, and then the company that were managing it, well, actually went bust as well, as a lot of other companies, when they were doing these highly leveraged models during that period. But still got it to this day. It's up in Huddersfield.
Right.
It's a two-bed flat. I don't know to this day why I bought it. It seemed like a good idea at the time. And actually, a lot of us in the military were buying through this particular deal packaging, deal management service. And unfortunately, a lot of people did actually lose quite a bit of money. I don't think I did. It's washed its face over the years, but I still have to say, I still think it's probably not worth what I paid for it, but it hasn't cost me anything. So until I sell it,
Yeah.
maybe give it another 10 years, it just
But
would have been an experience.
I suppose the upside of that is it got you started, and we all need to get started somehow, don't we? I mean,
Yeah.
mine was similar. It was a flat in Leeds, and yeah, it washed its face for its whole career. It didn't, we hear things like properties will double in 10 years. I think we both know that's very
Well,
case
it
specific.
yeah,
Um,
yeah, exactly.
and then, on the words I underlined there was like, this kind of concept of relentless pursuit of the mission. And I really feel like property demands that of us now more than ever. Maybe it's always been like this, but there's so many twists and turns that happen with property, whether that's the funding side or the project side, or even the, you know, post acquisition, post refurbishment management side. So many
Mm,
interesting things can happen. Um,
yeah.
so it sounds like your military career perhaps uh, gave you the confidence and mental resilience to deal with some of the challenges that maybe came later on.
I think so. I mean, it's funny because in my corporate career, I remember I was just recalling to my wife just the other day. I remember having this conversation with an old friend who I met up with during my corporate career, and they said to me, I was just talking about life and what I wanted to do next, and whether I was happy with my job or what I wanted to move on to do next. And I remember saying to me, "You're quite risk averse, aren't you?" And I thought, wow, never thought of myself as that. I used to be in the military. I'm a skydiver. I've jumped out of planes like 360 times. I'm a mountain expedition leader.
Mhm.
I've done, I'm a snowboarding instructor. I've done all these crazy things in the outdoors. And I've never been one to not be afraid of taking risks. You've got to be able to manage risk and take risks effectively to be in the military, because you're
Mhm.
putting your life on the line. But that always stuck with me. And then I kind of later on in life realized that actually, I need to be taking risks, managing the risks. And that's kind of led me to doing my own thing now. But something else you've mentioned, which I think is important for anybody who's doing stuff in property, we all have to accept. And there's a great quote actually at one of Brendan's events recently. It was actually Ben Richards, who's a good friend of mine I'm doing a lot of work with. Um, and he said, look, property is, if you can't handle the heat, then, the game is not for you because it's full of twists and turns.
Mhm.
For me, the most important thing, though, is working with people who are going to be able to hold their own, are going to work with you, and that you can trust and depend on when the chips are down. And that's
Mhm.
one thing you learn in the military. You want to make sure the people next to you in that trench, this is what you're trained to do, right? You're trained to fight to the death, achieve the mission when the chips are down, and you want to know those people around you are going to see it through, that you can rely on them, and that's what we're trained to do. And fortunately, when you leave the military, you enter the corporate world or the business world. There's a lot of people you can't rely on, and it's unfortunately when you see them under extreme pressure and stress that things start to fall apart. Everybody has their own threshold of resilience levels, and you never really know that until they are in a tricky situation. And we've seen a lot of that over the last couple of years. But my point is, whether you're, and this links very much to what we're talking about in terms of raising finance, you've got to give comfort to investors that you're going to look after their money and you're going to return it, that you can handle yourself and the situation when the builders go bust or the bank's calling in the loan or the market turns, the bill costs go up. And I've been exposed to a few of those things and still
Mhm.
managed to turn it around, but it does take its toll. I think I've got a lot more grey hair now than I used to have, but it's a very important thing that I've taken from the military. That ability to keep going until the job's done.
Yeah, definitely. So let's dive into it then. So I suppose, I suppose the theme of this podcast in a way is this idea of, you know, to take inspiration from your comment, relationship approach to raising finance. And I suppose in a way to celebrate the successes. We see a lot of, it's easy to see like negativity and in all around us. But from your vantage point, both as a practitioner in terms of your own work, but also within your network, could you share with us like some of the successes that you see? Like what works in terms of developing these relationships with private investors? So yeah, give us a bit of a whistle-stop tour of that. Like what do you see that works? Where are the successes? What should people seek to emulate? Because we know that capital raising is one of the most vital parts of the job. It's a very capital intensive activity. Everybody needs to do it. Yeah, so what are your thoughts on that?
Yeah, I think for a lot of people who are starting out in particular, this is a common conundrum, is it, do I find the deal first? Do I find the money first? And if I'm finding the money, where do I find it? I mean, I've seen people advertising things on Facebook. Maybe I need to do that, plaster my deal there and offer fixed returns to the general public. I mean, the first thing that I've learned over time is that, first and foremost, it's you that people are investing in. Where you have skills gaps, you need to demonstrate that you're working with the right people that can fill those gaps. And I think a lot of people don't realize what skills they already bring to the table. It might be, their first foray into property investment or doing a small project. But they probably come from a corporate career where they've got project management skills and they understand how to stack deals and spreadsheets and project management, the detail of getting things done.
Mhm.
And that's one of the first things that people need to make sure that they are capitalizing on. And where they have skills lacking on the project build side, then make sure you've got the right people that you can kind of give some comfort to your potential investors that you're going to manage the risks and get it over the line. More specifically, we all actually have probably all the money we need in our existing networks, and this is something we talked about when I chaired the panel at the recent Central London Property Meet. Um, we had a lot of experience on that panel. We had crowdfunding platforms. We had investment bankers who investors themselves, somebody who uses their SaaS pensions, well, as well as their own SaaS pensions from other people's SaaS pensions to get deals over the line, joint ventures um, with sellers. And we had somebody else who was talking about how, actually a big proponent of the relationship building approach as well. We we talked about how actually you don't need to necessarily have a big social media profile. You just need to make sure people you want to connect with are aware of what you do. So by doing that, you're ensuring that the people who know you and probably have access to funds, whether it's colleagues, friends of the family, whatever it is, they know what you're doing. And actually, most of us have access to that capital within our existing network. You just need to know how to work your network and make sure over time that they are aware of what it is that you do. And when an opportunity arises, they could be the ones who you need to fund rather than a stranger on Facebook or Instagram, which
Mhm.
I see a lot of people do. But sometimes you know um, they're in murky waters because of the way they go about it. But for me, I've actually focused on existing network, and I've got quite an extensive career background. And I've got people in my network who have funds, and depending on their risk appetite, which takes time to understand, we're able to eventually have conversations about the sort of projects I'm involved in, and I'm able to gain an interest from them in terms of what their risk appetite is, what they're interested in getting involved in, what their expectations are, and what their exposure kind of limitations are, so that when I have got an opportunity which might be right for them, I'm not starting from scratch. So it's about planting that seed, but first and foremost, making sure people are aware of what it is that you do through whichever medium you choose.
Mhm. Very good. Um, in terms of so awareness definitely makes complete sense. I think about that in terms of like sending the signal. So it's just really important for people to know on an ongoing basis, what you're doing. And if you're reasonably active, that's a pretty straightforward activity because you can just, when You recently exchanged contracts on a project, so you shared that with us so everybody could see the level of activity is going on there. I've been doing a plethora of refurbs over the last few months, and attain from time to time posting those. Probably could have posted those more, actually, in fairness. Um, I'm drawn to your comment about murky waters. So if we touch upon those murky waters, and I ask this in the spirit of no criticism of what people are doing on with their social media accounts. Most human beings are doing their best with the limited information they have. That's probably the
Yeah,
universal truth, isn't it? But
yeah.
what things do you see? So if we put it on a positive light, what do you see people doing on social media that you think, do you know what? That's very positive. It's a nice blue open water. It's unlikely to cause any difficulty. So what are those some areas of best practice that you see people doing?
Yeah, one of the things I admire is people who are sharing honestly and openly. These are the projects I'm involved in. This is how we've worked with our investors, just telling you the story of how they've done it. Now, admittedly, they've already kind of started,
Mhm.
but they're rather than talking specifically about, right, I'm raising investment for this deal and this is what I'm offering. It's more of a, this is what I've done today. This is what I've got on my pipeline. Just making sure that you're building a bit of a story so that people can see what you're doing, what you've been doing for some time. And then it's much easier to have those conversations about partnerships or involvement or investment without necessarily having to say, right, I'm looking for an investor. Would you like to invest in my project?
Mhm.
It's just a more natural way of getting a deal done. And I have to say, it's no different to trying to get a deal over the line when you're trying to purchase from somebody, whether it's a direct to vendor or build a relationship, or it might be that when you're going through your dating phase, you don't just come out with it straight away. You've got to take time to get to know each other. Are our principles and ethics aligned? Do we think we can work together? Can a deal be done? Okay, great. We think we understand each other and what's important. This is how that construct of the deal might look, or this is how this participation in this investment might look, or what is right for the individuals, because you don't want to just be transacting or working with someone, the first person that comes along. You've got to have the right fit with each other and know that you can work together when perhaps things aren't going to plan.
Mhm.
So I like the openness that I see in other people in terms of how they've worked, what sort of projects they've done, what they're doing, and just allows you to build sort of some sort of understanding of who they are and what's behind that person as well. So social media can be very powerful for that, and I've seen a lot of people doing it very, very well indeed. But if you're not on social media, it's just a case of getting out and talking to your network and engaging with them. Because at the recent event, somebody, one of the panelists was talking about how actually his biggest investors aren't even on social media. So actually, it's very, very good to be going out there and just talking to people, building that relationship or strengthening those relationships one on one. And that's how I kind of, like to work as well. And that's very much what drives this relationship driven approach to whatever it is that I do in life, including
Mhm.
raising finance.
Yeah, yeah. I was once invited to a meeting which was hosted by a lawyer on behalf of their clients, and the purpose of the meeting was it was kind of I suppose a bit of a beauty parade maybe, but where they were kind of just it invited the group first to, in principle, just discuss what possibilities there might be for their clients um, investing in the UK property. And it was really interesting because somebody asked that question. They said, do I need to have a social media profile to tick the box? Is it one of the first boxes I need to tick? And the lawyer was really candid about it. He said that my clients go to great lengths to preserve their privacy. Just to be clear, they don't have social media profiles. Whilst it is something we would check out as part of our new due diligence process, it's not going to be the end of the world. And I've heard subsequently from other angel investors that actually an over-engineered social media profile can actually be a bit of a turn-off as well, because the
Mm.
question arises, like, how much work are you managing to get done behind the scenes of this impressive profile? If we um but I think just from a practical perspective, people are always going to check you out. It's the realities of life. They're all, that's the world that we live in. And I think we need to make it easy for people to do a quick surface level amount of due diligence. Whether it's a well presented LinkedIn profile or something else, just so they can begin to form the foundations. Because I think
Mm,
certainly when I've come across people and you do the basic level of due diligence and there's absolutely nothing to be found, um, it does not suggest anything untoward is going on. It's just I don't have the will then to probably invest more time in it because I can't
mm,
even find the things I would obviously expect to find. I mean, maybe that's the kind of lawyer in me, like being, so concerned as to risk as to find like a dead end before I need to. But and then I suppose if we look at it from another perspective, and again, without any sort of hint of criticism, people are no doubt doing their best. But what kind of things do you see on social media that you would probably say is, I'm going to use the word suboptimal. Now, there's no doubt a lot of stuff we see on social media which probably, well, inevitably is in breach of um, the FSA regulations. People who are not authorized by the FSA to make financial promotions, for example. But
yeah.
what do you see that we could categorize as suboptimal or not ideal if somebody wants to build a relationship?
Yeah. I mean, unfortunately, this is whether this is something that comes out of training courses or perhaps people see similar behavior on certain groups. They think that actually that's perhaps what I need to be doing as well. I think it's important that people put their message out there, but quite often you see people who are looking for funding for a specific deal, and these are the terms they're offering over this period. And I think the whole point of the financial promotions sort of regulations are that you need to be able to certify your potential investors as either high net worth or sophisticated investors. Now, I'm not going to go into the criteria because I think anybody who wants to be doing stuff in the space needs to research those areas for themselves.
Mhm.
The FCA guidelines are quite clear. Well, actually, it can be a little murky as well because sometimes they can appear so restrictive because they're not actually geared specifically towards property investment or raising finance for property deals, but they still hold true for that sort of activity. But what I see quite often is people offering certain things, and it might be deemed a collective investment scheme where actually a bunch of investors are coming together who are strangers, or you don't have that relationship with them for them to fall outside of the guidelines. Or sorry, where you shouldn't be talking to them about a specific deal, where they're not deemed sophisticated enough to understand the risk associated with it. So sometimes you see people talk about offering this sort of level of return, and it might be a very high return, which might attract people because they're like, oh wow, that looks great. If I can get 15 or 20% for lending you 50k or 100k over the next 6 months or 12 months, whatever it might be. But the problem is you're not communicating with them what the actual risk of that project is. Is there any security? What security providing at all?
Mhm.
Is it debenture, personal guarantee? Is it first charge, second charge? And most people don't understand that. So, and I think it's the investors as well as let's call them the promoters. And that's what we want. We don't want to be falling foul of is those promotion guidelines or rules. So I do see that sometimes, but I think it's more because people are simply unaware rather than they're taking risks that they're aware of. But that's probably the sort of thing. Yeah, here's
Yeah.
my deal. Here's what I'm after. Here's what I'm offering as a rate. If anyone's interested, please drop me a line type thing. But the interesting thing is that I know that some people do invest on that basis as well, which is probably the more worrying thing because um, it can work, but that's when people get into trouble. Unsophisticated retail investors, and we've seen a lot of this with pensions and funds that people have put a lot of money into, and unfortunately have not seen a return because you assume that it's been endorsed, it's been checked, and that somebody else has okayed it when that's what unfortunately is often not the case. So those are
Yeah.
probably a couple of the things I've seen which are perhaps suboptimal, to put it mildly.
So then, if we were to link it back to kind of previous comments about what we could say was a better approach in terms of what you alluded to, which is having a profile, putting it out there, evidencing the current work you're doing, uh, avoiding talking about specific projects, and certainly avoiding, anything that might resemble a promotion. But it sounds like your first step is then what a friend of mine would call a chemistry meeting. So he works in a different industry, and he's, the first meeting is always a chemistry meeting. Like, are we going to be able to work together? Do we have shared values? Do we have a shared direction of travel? So there's no discussion of deals, contracts, the detail. It's just who are we as people? Where are we heading? That sounds like that's kind of similar to the approach that you take with people. So you don't rock up with like a pack and you're not talking about a project. You're just getting a sense of them and you're giving them an opportunity to get a sense of you.
Exactly that. I mean, I might show them at some point, here's an example of the work I've been involved in. This is how I've worked with investors just to keep them appraised, to pique their interest. But I'm not talking about a specific opportunity because I would never expect somebody to part with a large sum of cash just on one meeting. So one of the things, and this is one of the important things about when you're raising finance, is that you have to qualify your investors as well. You have to understand if they actually understand what the kind of risk tolerances are.
Hmm.
How much is it that they're willing to put on the line? Do they realize what the likelihood is of potentially investing in something and not seeing their money again?
Hmm.
Because I'll give you an example. There's a couple of deals that I'm negotiating at the moment where there would be a joint venture of sorts, and a builder I've done a fair bit of work with historically was looking to get involved in that project. But when we talked about the numbers, I could see that the amount of money they would potentially be putting on the line would actually be a significant chunk of their liquidity. And I thought, actually, you know what, that's probably a bit too risky, and I don't think this is the right opportunity. This particular deal with those parameters is going to be right for you. And actually, I'm a firm believer that it's much better to get to the no
Hmm.
early rather than getting to that no at the end of the process when you've put all that work in. So ask the difficult questions up front. But this is one of the things when we're qualifying potential investors is, do they actually understand the risk profile of this, and how much can they afford to lose? And quite often that's a big indicator for me for whether I even want to be considering even talking to them about an opportunity or not. And you can gauge that, very subtly without even having to talk about deals. But that's one of the key things for me in building that relationship, to understand where they are and what they're do they understand the relationship between risk and reward.
Hmm.
And that's what we need to be aware of with those high rates of return, which are sometimes which are bantered about.
Yeah, definitely. And you see, and you've alluded to already, that a necessary step is likely to be them certifying that they're high net worth or a sophisticated investor. And obviously that has to come at the appropriate point in the journey that they're on with you. And at this stage, you've just had kind of convivial social conversations with them, not relating to an actual undertaking of a project. I always think a great resource in this respect is, what you see in other parts of the industry. So, for example, you've touched on collective investment schemes. I once, I have a real interest in forestry, for example, and one of the things you can do is you can buy shares in a collective investment scheme in forestry, and it's one of the best performing at the right stage of a person's life. It's a really good performing asset, has certain incentives that are quite useful. But what's fascinating is once you have the idea that that's what you're interested in, you go to the firm that provides it. Um, they will not talk to you about a collective investment scheme, despite your like any, as excited as you might be to learn, they're not going to tell you until you go through their process. And that process is one of self-certification and what have you. And I've even noticed in the last 5 years, I've been asked to self-certify before going to a meeting.
Mm,
And I find that really fascinating. Like we'd like to invite you to this. Before you attend, please can you return this form? I thought, wow, they're taking this very really seriously, which in a way I like. And I think
mm,
if you're used to seeing it, when you don't see those kind of steps, it does make you think. Um,
yeah.
Say, for example, and we can all do this, couldn't we? You could go to your favorite financial platform, whether it's a crowdfunding platform or whatever, and you could, if assuming you got a genuine interest as well, you could look at what the process that it takes to onboard as a client, and you'll see the steps that they take you through. They want to know who you are, where your money's come from, and whether you are able and wish to self certify. And I think that's quite I think that would be a valuable experience because you can see how other parts of the industry do it. I don't know if you've got any thoughts on that.
Yeah, no, I think it is one of the first things that comes to my mind is that you and I come from regulated backgrounds, so we're used to seeing that level of diligence and standardization to qualify people early. I think there's a lot. The thing about property that I've found is that you have such a diverse range of backgrounds, professional backgrounds, and different levels of let's say compliance with rules and regulations, because it is quite literally the Wild West. Um, and it does need more of that sort of fabric and framework to ensure that people are doing things in a way that is going to offer some level of safeguarding. But it's a capital intensive, high risk, potentially high reward sector. So actually, it's naturally going to attract people with different levels of risk appetite.
Hmm.
Um, but I think yeah, to your point, it's good to see that level of diligence and certification where it does exist. I think we're a long way away from seeing that in the property space, just because it is so wide ranging, with different levels of entry, different players. Um, but yeah, I think if I'm answering the question, yeah, we probably could do with more of it.
Hmm. And I think you often and like some of the language that is used. So, I've had previous podcasts or guests who are published authors, but they were also in the process of launching funds, for example. And they're really clear about what they can and can't discuss. They're absolutely, they've had the conversation and they're exactly the areas that they can't avoid. And I think, it seems like between every breath, you'll hear words like, this is not subject to any form of insurance, or your capital is always at risk. This is a very
Mm,
illiquid investment. You may not be able to get your money back, even if you want it to, within the time frame. And it's interesting. We could all do well to understand that is the kind of language which you see in other aspects of the finance industry, which we could probably learn a lot from. When you
yeah,
get an email from a platform, crowdfunding platform, for example, have a red box at the bottom of the email. Capital is at risk. This is illiquid. You may not get your money back. Um, how many of those emails are getting sent out in the context of raising private funds? I've no idea, and I'm not going to comment. Um,
mm,
so obviously, you've worked in a regulated space, and I mean, you've worked for one of the most famous worldwide banking institutions on the planet. And obviously, I've worked in legal practice. What are some of the from a practical point of view, what are the kind of things that help work well with professional advisors if you are using private private finance?
yeah. So I guess your investors, in fact, it's not just your investors, your debt providers, your funders at every tranche of the capital stack want to know that their funds are secure. So obviously they'll get you to sign all sorts of bits of paperwork, debentures, personal guarantees, deeds of subordination, whatever it might be, to
Mhm.
protect their tranche, or their slab of the finance that they're providing towards that deal. So working with professionals is key, and sometimes you do that to reduce the exposure. Sometimes it'll be mandated by that investor or by that lender, for example,
Mhm.
or to make sure you've got a monitoring surveyor, somebody who's going to be managing the spend of the build. Make sure you've got a project manager. What are the credentials, background of the construction team? How have you, have you checked your costings? Have you got a QS, etc.? So on the construction side, you've got that side of it, but then also your solicitors, the people that are representing you, providing all your paperwork, whether it's your loan documentation, whatever you've had to do in the background, having people who are on the same page as you and understand what it is you're trying to achieve is key. But more importantly, having people who are experienced
Mhm.
in that particular in that type of deal or that sort of transaction, who are actually going to work in your favor. I mean, there's nothing worse than having. It's probably more relevant when you think about. I'll give you an example. When you're trying to structure a deal, for example, where you might have to have some sort of creative deal structure with a seller of a property. If their legal representation just does not understand this sort of deal structure, then it's a non-starter because they're going to be
Yeah.
advising their client against it. I mean, recently I had to, exchange on a property where we were trying to negotiate a delayed completion, for example. We had agreed it already with the seller, but then
Mhm.
when their lawyer got involved to sort of finalise the paperwork, it was clearly a no, don't do it. There's risk in this, risk in that. And we were like, well, we talked about this up front. And literally, when we're about to exchange, why are you bringing that up now?
Mhm.
So it's important that not just you, but the counterparty or who you're working with actually has a professional advisor that is on the same. I want to say on the same page, but obviously they're counter to whatever it is you know presenting because they've got to protect their clients' interest. But it's got to be somebody who's going to work pragmatically and understands what it is you're trying to achieve.
Mhm.
So to answer your question, I think your professional advisors need to be knowledgeable in what it is you're trying to do, and hopefully, if there's a counterparty professional advisor, ideally they need to have experience and understanding of that particular proposition or structure or opportunity as well.
Definitely. And there has to be that willingness to like go forwards with good faith and work towards having the project go to completion. I mean, I think it's instinctive to want to come to the defense of my lawyer brothers and former lawyer brothers and sisters, but I think that the problem is the training as well is that lawyers are trained to be obsessed with risk, and to protect their client from risk at all times. And they're also very mindful that should your standard of conduct fall below that of a reasonable lawyer in that area, that you're going to potentially be open to a claim, and that's not very good for your for the practice, but it's probably not very good for your career as well. And then there's insurers can get involved. So it's difficult, I think, for lawyers as well, because they're trained to take the other side of this, and
Yeah.
really, you've got lawyers who want to do the deal, and you've got lawyers who want to pull it apart. And you need to be, I suppose, everybody needs to be on the right side of that. But look, there's some great people in the industry. We know them well, who very professional, and they're able to get these projects across the line. It's tricky when you've got a counterparty, who isn't quite on the same page. In that situation, what could you do? Well, it is the client's decision. Lawyers are
Mm,
there to advise. It's the client's decision. The client can change their representation. They can, they can, they are the captains of he or she is the captain of the ship, aren't they? Um, one of the things that's worth just kind of signposting, I don't want to make too much of this, but, in addition to like not making financial promotions and dealing well with our legal advisors, making sure the formalities in place. Obviously, we've got to, it's worth mentioning for a second, anti-money laundering. In professional firms like the firms you've worked in, firms I've worked in, that I cannot tell you how seriously that is taken. If you do not comply with the internal policies of your firm, you will not have a job. But it is really that seriously. And I think we can all learn a point from that. I think there's only 2 points I would make and then come to you is one, um, get ahead of that, so speak to your professional advisors, make that sure they understand if you're using private finance, make sure everybody, like the people who are arranging other aspects of your finance, give them that transparency, make sure everybody knows what they need. Lawyers and professional advisors don't like surprises. Yeah, it makes
mm,
them really nervous if they get surprises, and it may make them so nervous that they don't want to continue with the transaction. So give them lots of ability. And I suppose just as a health warning as well, not everybody's money is equal, and you don't want everybody's money. There are people on the face of this planet whose money you absolutely do not want under any circumstances.
mm,
Um, having well, at the very beginning of my legal career, I had the opportunity to look at cases involving serious organized crime, and that's not a space that any of us want to occupy. Do you
mm.
have any? I'm not going to draw you on this if you haven't got anything to add, but did you have any comments about money laundering or that kind of aspect of things? How you may have approached it? What your thoughts are?
Yeah, no, I think it's such an important topic that most people don't appreciate just how important it is. You'll people should be familiar with terms such as KYC and AML. So that's know your customer, know your client, or anti-money laundering, but PEP as well, politically exposed persons.
Hmm.
I'm familiar with that one because there's someone who's got a similar name to this. Has come up in a couple of legal searches recently. Someone who's got a similar name to me is a PEP, and they're like, "You're not this person who lives in this country and is an MP, is an ex-prime minister, are you?" I'm like, "Well, no, it's not me."
Not me.
But yeah, not me. But it's important to be aware of these things, and as you say, bring your lenders, your brokers, your professional team up to speed early with where funds are coming from. And
Yeah.
as we've said, we both agree that not all money is equal.
Mhm.
Know who it is that you're borrowing money from when you get to that stage, and obviously that's why you need to build that relationship over time to know whether you want to be associated with them and whether your interests and principles are aligned. But being upfront with your lenders, your brokers, etc. This is where the money's coming from. This is how we've structured it. Because it's much easier to get to that no earlier. Actually, there's going to be a problem with that.
Mhm.
Being prepared with the sources of that capital, 6 months bank statements, etc. Of the person that's providing the funds. These are all things that get asked for, but being organised about it is important. Interestingly, I actually run a podcast with which we touched on earlier,
Mhm.
with a broker, and I provide the input and the questions as a borrower.
Mhm.
And one of the things I actually do, I make a point of, is building relationships directly. And by the way, that podcast is called "Show Me the Money." It's all about
Nice.
what do you do to unlock property finance? What are the steps you need to jump through, or the hoops you have to jump through to get money released to you from the lenders? So we talk about the due diligence process, the underwriting process, what solicitors are looking for, what they do in their checks. So we cover some of this as well. But one of the things I do is I build relationships directly with underwriting teams and lenders, sometimes the principals themselves. So I always work with the end in mind. So
Mhm.
all the way, so I'm building a portfolio in South London. That's my kind of one of the main activities of my business.
Mhm.
Um, I build relationships with the term lenders, the mortgage lenders directly, so I know what my exit is likely to look like. Is the sort of project they're going to be willing to fund, and what sort of valuation instruction are they going to give, so I can try and forecast a little bit more accurately what the GDV is going to be like, especially if it's on an investment valuation basis. But my point is with all of this that building those relationships early, sharing where you are, where you're coming from, where money's coming from, having to sort of check it with those key decision makers early is
Mhm.
far better than spending all that money through an application process and getting to that no later. So yeah, absolutely have visibility, know yourself, where the money's come from if you are working with external investors, and make sure that especially if it's a creative structure, that your funders are going to be happy with that. So that at least when it gets to the solicitors,
Mhm.
if they're going to make a mountain of it, then they can take the credit department or the underwriters can take a view and say, actually, we're happy with that potential risk because we've already looked at it.
Yeah, I think that's really good advice. And I think as you're talking from the perspective of an experienced practitioner, where clearly, even before day one of the project, you've in your own mind completed the project, and you know where the exit finance arises. And then certainly I know that in our cases we always had a plan B, because the world is full of surprises, unusual valuations,
Yeah.
yeah, all that kind of thing. So we always had plan A and a plan B, and you can get genuine comfort as well by asking those difficult questions ahead of time and saying, like, what's your attitude towards this? And it's nice to get that message back as you do. We're completely relaxed about that. Thanks for letting us know. We can see the overall picture. We're happy with what you're doing. I sometimes wonder why some cases go slightly off when you hear about good people doing good projects, and yet the finance going off the rails. Is there do things go far down the track, and then is it like a file review process that takes place the day before completion, and you hear about these horrendous additional terms being brought out, and you just think, well, that could have been handled so much better by everybody
Mm,
in the chain if all of these difficult questions have been asked by the beginning. And I sometimes find it a bit unforgivable when you hear additional requirements being made just before completion, because everybody's so invested at that point, and
yeah.
everybody's feeling the pressure. And yeah, we all could do without that, couldn't we?
Mm,
In terms of I think my final we'll get to my final question in a moment, which is about being an investable human. But I suppose before we get to that, we know you've got the Show Me the Money podcast. Um, Tell us what else is going on, like what you're doing property wise, what's going on in your portfolio, what's the future look like?
Yeah, so I'm doing a few things. Got some single lets, which I don't do anymore, or those are like in personal name, which I think we've all learned over time because there's not much a market for that anymore. So I started investing in HMOs in South London.
Mhm,
So doing like large sui generis HMOs, large back to brick buildings,
mhm,
professional HMOs. I sort of stick within a certain range of where I live. I try to sort of be no more than sort of half hour to 45 minutes of where I'm based because I've had, one of my first projects, the builder went bust halfway through. So I learned the importance of being not too far and
yeah.
managing that site, myself with all the subcontractors and tradespeople to get it over the line. And that was a real baptism of fire, but we made it work. But, with that in mind, my personal strategy is to invest in areas where I've got the relationships, I know the market, and I can get them to respond if there is an issue, not just during the build, but for the longevity of holding that investment as well. So HMOs professional have also been doing some stuff with registered providers, which is a whole nother ball game. Has its sort of benefits and rewards in terms of housing vulnerable people, but also comes with a lot of challenges. It's a
Mhm,
very, very challenging space, not for the faint-hearted. I also do planning uplifts, so I've got a couple of deals which I'm negotiating where I work with the vendors or the owners of a site or a building where they're not able to sell it, but there is a way of structuring a deal where we collaborate to create that uplift, either through planning or some physical refurbishment, and then
mhm,
sell that on. So that's more of a rather than building to sell or trading properties. That's kind of my what I call my liquidity strategy. So
mhm,
I've got my long-term income through the slowly and surely building this portfolio. Second, because that's quite capital intensive, working with investors, and sometimes you've got to leave capital in the deal. So I've got to have a liquidity strategy, which is money that we can create relatively quickly, higher returns, sometimes a bit more riskier, but I look at ways to de-risk by working with the vendor rather than incorporating the cost of capital by making an acquisition and stamp duty, all that sort of thing. So I'm doing a bit of that. But I've also got a third strategy which I'm working on with a couple of other business partners, which is using our SaaS pension money to acquire commercial buildings that are below market value or been poorly marketed, or there's lots of scope for increasing the value, which we then look to create that increasing value either through planning or through asset management, and either hold or sell on if there's an opportunity to do that. I really want to build my SaaS pension value up by working with other people that one day I can use it, build it to a big enough pot to better lend to myself effectively. And I'll
mhm.
pay my pension the interest rather than paying it to a third party lender. So those are the things that I'm doing. We do that all over the southeast. Looking at commercial buildings, we bought something recently, which we've got a couple of offers on the table for already, which we're just negotiating. And obviously on the HMO side, I'm looking at large buildings which can be subdivided through planning into flats, and then using the PD strategy where that exists, where there's no Article 4 to convert those flats to HMOs, so you can get pretty significantly sized HMOs as a result. But my investment areas are quite high bricks and mortar values, so it's quite hard to make deals work. So you have to really better add value and increase value to those sites, whichever way you can to make them stack. That gives you a bit of a flavour of what I'm up to.
Yeah, definitely. And we're going to put a link to your LinkedIn profile. And obviously, we've got the Show Me the Money podcast, which I've listened to on Spotify, but presumably it's available on Apple and all the usual places as well.
Yeah, Apple and Acast and the other platforms. We've got to do a few more recordings. We're a bit behind on our schedule, but there'll be more of those. But yeah, very happy to connect with people on LinkedIn. It's a great way. I think, as you were saying earlier, it's important to have different ways in which people can find you.
Mhm.
So I like to put as much out there as I can. I'm not massive on social media, I have to say, but actually I'm probably posting a bit more because I'm getting more involved in events and with various deals that I've got in the background at the moment. But yeah, LinkedIn is great.
Fantastic. And so then I suppose the final question, final thoughts, if people listen to the podcast and, they're considering their own position and it's, becoming investable is really important to them. It's going to be a vital step in their next stages. You know, Anywhere between us, what your kind of 3 to 4, maybe five points you think, would be helpful to people in becoming a more investable investor developer?
Yeah, I think the first thing is authenticity. Be yourself. Don't try and portray yourself to be something that you're not, because people will see through that very quickly.
Mhm.
Don't overstretch yourself. Do things you're comfortable with. You have to take, well, you have to push yourself outside your comfort zone, but do it in a
Mhm.
way where you know that you can manage the downside risk as well. Have the right sort of people around you, because you will always have skills gaps. But build confidence with people that you're talking to show that these are the people that you're working with, that are going to help you to manage risk and get things over the line. And just be honest with people. Be honest about what your weak points are, but most importantly, what your strengths are and what it is you bring to the table, and what examples of adversity when things have not gone to plan, but what you've done about it to make sure your interests and your investors' interests, or your other stakeholders' interests, were looked after. And it doesn't necessarily need to be a property deal. It could be something that went wrong in a corporate career or in your personal life, and what you did about it to fix it, because that's a key part of that authenticity, and people knowing what your resilience levels are, and how you deal with problems. It's no different to when you go to an interview as well. Tell us about your weaknesses, and oh, I work too hard, or I'm my own worst critic, or whatever. Just be honest. Be honest with people, and people really admire that. That's probably what I would say is what I try to do.
I think that's really excellent advice. Well, look, Ray, it's been a long time, and next time I'm in London, perhaps we can revisit that Lebanese place. And thank
Indeed.
you so much for coming on the podcast. I really appreciate it. You've given us so much value. You've given us a lot to think about. So thank you very much for coming on the podcast. It's much appreciated.
No, thank you. It's been an absolute pleasure, and I know you're an fellow adventurer as well. So we've got a property mountain biking group as well down in Bracknell Forest. So a few of us from the southeast go and do that. But perhaps you can come and join us one of those, and I'd love to do some hill walking with you at some point next time up in the north.
Do you know what? I would be thrilled to do that. So let's have a think about that. And that, ladies and gentlemen, is the Property Investor Podcast. Thanks so much for listening. It's very much appreciated. If you have enjoyed the podcast, and I hope you have, please do subscribe to it. Do find Ro on LinkedIn. If you would like to review the podcast, of course, that's really welcome. And if you want to discuss anything that we've talked about, you're always welcome to join me at one of my property and investor breakfasts. We do them online, we do them in person. It'd be great to see you. Keep well, speak soon, and thank you very much for listening to the podcast.